Thank you, Yuri, for the very warm introduction. Just to be exact, I didn't really set up the office myself in London. It was under the supervision of my boss and very experienced ship financier, Richard Janssen. So, to jump in our panel, ladies and gentlemen, welcome, and thank you for joining us today for this panel discussion. The title of the panel discussion is Remapping Ship Finance Opportunities. Now, before jumping in and asking our 6 panelists to briefly introduce themselves, I would like to make some opening remarks. Shipping, as we all know, is a historically bank-financed industry. But with the exodus of traditional shipping banks from the space, as experienced over the last 8 years or so, a large financing gap was created, which in turn led to an influx of fresh capital primarily sourced from alternative investors. Private equity money has entered the space dynamically through the acquisition of shipping loan portfolios, the ones sold by the historically shipping banks, as well as through new and existing credit fund type vehicles offering senior and junior loans, sell and leaseback structures, as well as preferred equity solutions. In addition to international private equity capital, Asian money in shipping has shown significant growth, mainly in the form of Chinese leasing structures, which in many cases provide shipping with extremely competitively priced capital. Furthermore, this decrease of cheap banking capital paired with squeezed profit margins due to prolonged, essentially depressed shipping markets, has led to a wave of technological innovation in shipping, which has found its way into finance, as witnessed by the appearance of various online ship finance platforms. In this volatile and rapidly shifting finance landscape, ship owners are called upon to align their capital structure and their strategic decisions more closely than ever before in order to satisfy their financiers' requirements and still be able to achieve their long-term goals. The objective of this panel is to hopefully provide us with a slightly better understanding of where this shifting finance environment has brought ship owners today and where it will take them in the near future. I would like to ask all of you if you would like to say a few words about your background, and then we can jump into the questions, essentially. You want to start with Dimitris?
I've been a banker for quite a lot of part of my career. Mostly served getting to know shipping through my employment with the Onassis Group, the old days when the headquarters was in Monaco. Then I joined an American bank who went bankrupt, so I had that experience too. And then mostly I worked for 20 years as a head of shipping for Greek shipping at the Aegean AMRO Group. And then about 10 years until now with Aegean Baltic Bank, as you know, a boutique Greek bank. And I would like to contribute here, whatever I can contribute with my experience all over these years.
Christoph?
Thank you for inviting me to the panel. So before having joined Meerbaum in early 2018, I've been with Commerzbank in Germany for many years, and most of the time I've been in the ship financing business there. Among others, I had the position of the head of Asia Pacific business. And then, I mean, as most of you will know, most of the German banks then later on came into the situation where there was no more business to be built up, but to run down the portfolio. And after having done that for a while, and then joined Meerbaum, who's an advisor company advising investment entity which sourced from private equity.
Ali? Thank you. Thank you, Christoph.
Thank you. My name is Ali Susanto. I work with Braemar, Naves in Singapore. I've been in shipping finance since 2001, initially with DVP Bank, more with the investment management arm, at that time called NFC Shipping Funds. I was with there for 9 years. At that time we raised money from Norwegian American investor, buy vessel, and put it on bareboat charter to shipping companies. We ride the cycles of this 2007, 2008 boom. So it was nice, but at the same time also we have seen the downturn as well. In 2010, 3 of our member teams were recruited by Standard Chartered Bank to start the ship operating lease business. And then we were there until 2017. And then since then, I joined 2018. I joined Braemar Naves, and taking care of the corporate finance business activities in Southeast Asia. We will see later on my observation on how financing landscape has changed totally in Asia. How it impacts the financing market, including shipping companies as well. We'll discuss more later on. Thank you.
Thank you.
Yeah, I actually started my career in a company repairing ships and pleasure yachts, a technical office. Then I joined RBS, where I stayed for almost 15 years, dealing with ship financing. When RBS decided to exit shipping and closed, I moved to NJ Goulandris, Andriaki, as a business development manager. And for the last 2 years, I've been the head of financial advisory of Intermodal Group. And we're trying to help our customers to meet their financing needs.
Thank you, George. Laios?
So, yes, George Laios.
I am George Cambanis. I founded the Greek Deloitte firm here in Athens. I also founded and ran the global Deloitte shipping practice. In May of 2018, I joined YieldStreet to help them build a marine finance platform. YieldStreet is an online wealth management platform. And here we are. We've, in the last 18 or so months, we've looked at shipping loans globally of around $2.5 billion, and we funded around $250 million.
Thank you, George. Harry?
Thank you. My name is Harry Kosmatos. I'm the Corporate Development Officer of Tsakos Energy Navigation. I started my career, I'm not going to say when, but with Elka Shipping in London many years back. And then I moved to the Commercial Bank of Greece in London as a credit analyst. And then I spent 7 years in New York with AMA Capital Partners, a maritime investment banking boutique. And for the last 15 years, I am with TEN, responsible. I'm the corporate development officer, responsible for unearthing and structuring alternative means of financing, anything from equities, preferreds, and anything in between. So non-conventional means of finance.
Thank you, Harry. Now, for the ones of you that have checked the agenda, you will have probably seen that we're supposed to be joined by Yves Kalina from the Hamburg Commercial Bank. Unfortunately, he was not able to make it today because his employer didn't allow him to do an international travel because of the coronavirus outbreak. So, to jump into that discussion, and for the sake of convenience, basically, in the interest of time, because I understand that our initially 60 minutes have been slightly cut down, I would like to divide basically the main shipping source of capital into 4 main categories, which will be represented by 4 of our panelists. More specifically, traditional banks and new-entrant banks will be represented by Dimitris, credit funds and private equity by Christoph, Asian sourced capital and Chinese leasing by Ali, and Fintech solutions in shipping by George Cambanis. Then, of course, we can have George Laios and Harry join the conversation and discuss how the Greek market is affected and how the shipowner side views things. So my first question to our panelists, starting from Dimitris, if I may, is how do you see the current shipping finance environment for traditional and new entrant banks, as well as how do you envisage the future over the next 5 to 10 years? Essentially, what I mean in a few words is what is the momentum in terms of capital provided by this specific capital source or those 2 specific capital sources, and how do you see the amount of money changing or the market share of those 2 capital sources changing over the next 5 to 10 years? And also, which factors do you think are going to be the main ones that will affect this development?
Well, you have put a lot of questions. One answer to the question about the future, whoever can predict more than 6 months to 1 year basically is a crystal ball projection. So I will say today we've seen the trends through the years, the last decade. We've seen the banks virtually, if not departing, at least taking smaller share of the pie of the financing, of ship financing. A lot of funds getting into this to finance that particular gap. They're more flexible. Banks have been hit by a big number of regulations. They spend most of their time, the personnel, to writing reports to the central banks and meeting and complying in various ratios, etc. At certain point, this has been a big obstacle to the largest bank, that they have decided to completely depart of the industry. That is obvious that somebody has to fill the gap. It is also important that the last decade we've seen a lot of things happening in the industry that when we had the post-Lehman Brothers crisis, we have for the first time seen how banks they try to recover their debts, not like the 80s where it was very easy to take ships to an auction, and these days that's practically avoided. They try to find means and ways to restructure debt because every write-off in a bank results in additional capital requirements, and this is the biggest game. And then we've noticed about a few things that they were not present also in the past, creating unfair competition to companies that they have been bad debtors, that they have benefited big discounts from the lenders, and companies that they were paying even when the vessels they were not making money. So we're talking about a very different environment, and in that environment, every time there are new things happening, the politicians creating needs, then those needs translate into heavy regulations. The environment, of course, is very important, and the shipping industry has to face this cost to meet all these new regulations, carbon, sulfur, all these things. I cannot project, but I see more and more flexible financing coming into it rather than from the banking industry, because either banks have to comply into all these at a quite high cost, which probably does not make very profitable ship finance, and I think more prosperity will be held by the various funds that they will be able, as I said, to fill that particular gap.
Mm-hmm. Thank you, Dimitris. So, bottom line, I understand that you see that traditional banking capital will retract even more, thus create even a larger space for alternative investors to enter. Okay, understood.
That's correct.
Perfect. Christoph, would you like to give us your views from a credit fund and private equity, essentially, perspective in the shipping finance industry? Exactly the same question. So how do you see the market today? How do you see developing? And main factors do you think will affect this development during the next 5 to 10 years?
Well, first of all, I can only agree with the analysis Dimitri just gave us. I mean, there have been a lot of banks suffering in the ship financing business, and in addition to that, the increasing regulations imposed on banks today is a real problem. So it is quite obvious that there are less banks active now in this sector as it was the case before. I know that from my own experience. So that indeed gives room, or they open up new opportunities for capital providers outside the traditional banking scene. And this is indeed then level playing playing field, not a level, but a playing field for private equity. And it is obviously true that there's also a difference with regard to regulations, at least for the time being, which gives a bit more flexibility to financing by means of private equity. However, to my mind, you should not draw the conclusion from this difference that there is, in any case, a higher risk appetite. I think, at least that's what I can say from my point of view. We are very much also conscious about risks, and we should also aim, as or credit funds in general, should aim for reasonable risk profiles in the projects they are financing. So that is, to my mind, quite important. But in general, I would see a situation where there's more room, or there will be more room in the foreseeable future at least, for private equity, for credit funds. If you are asking what is the case in 5 or 10 years, to be honest, I think that's too far away. Yeah. Because, I mean, we've seen what can happen within shorter periods of time. But for let's call it the foreseeable future, I definitely would see opportunities. I mean, the demand is there for ship financing. I mean, that demand has not stopped just because banks have withdrawn, or some of them have withdrawn. So I think there is indeed, as Dimitris said, there's a gap which has to be filled, and that should give us opportunities.
Mm-hmm. Okay, thank you, Christoph. So from the standpoint of Asian-sourced capital and Chinese leasing, how do you see the market, Ali?
Yeah, it is interesting indeed. I will share a little on more details on what I see is basically it will have a big impact on shipping industry. So I think all of us know that the Chinese leasing company has stepped up their presence in the past 10 years. So the first introduction of the leasing regulation in China was approved in 2007. And 2008, 2009, there you see the start of the Chinese leasing company, started with ICBC leasing, CDB leasing. It basically from zero, and you will see the leak of the financier in shipping in 2019. Out of the 20 top banks or leasing companies, 7 of them are from China. With exception of China Exim, which is now the second largest lenders in the shipping industries. The other are basically Chinese leasing company. And when they started actually in 2009, 2010, we see the Chinese banks providing loans as well. But gradually, they stopped lending and it all taken over by the Chinese leasing company. I think we discussed, the earlier panel also mentioned about the uneven playing level between, let's say, credit funds and the banks. And similarly with the Chinese leasing company and the Chinese bank, there is also uneven playing level field, because as a bank, then you are subject to a lot of regulation, capital allocation. But the leasing company, which is also owned by the holding company that owns by the banks, are not subject to that regulation. So they have more flexibility to deploy their capital and to allocate their capital and to do deals. And then there was a further change in the regulation in 2017, which allowed more conglomerate and other finance company in China to establish a leasing company. So as of now, there are basically more than 50 leasing companies in China, of which 15 are looking into shipping. And as the data what I get is, as of last year, there were around 70 to 80 billion exposure of this Chinese leasing company. This number is slightly, I think, or not slightly, is overstated, because what not many people is saying is that behind this leasing company, there are also a lot of basically loan from international banks lending to the Chinese leasing company. And this is interesting because, for example, the few of the global banks that I previously worked with and now, if they lend to the Chinese leasing company, they treat this customer as a FI customer. So not as a shipping companies, and as a FI company, these leasing company are basically rated AA, single A, financial institution, and not a shipping company. So the capital allocated for doing such deal is much lower than lending to the shipping companies directly. That's why you see the shift also from big banks, even like ING, Standard Chartered, they can lend to the Chinese leasing company, but towards a shipping company, Chinese leasing company, but towards shipping company, they are more cautious. And this trend will continue with the introduction of application of Basel IV. And if you speak to the Chinese leasing company, they are still bullish. Of course, I think what I've seen in the past few months or 1 or 2 years, they have been a bit more cautious. But I would like to highlight also that the financing in China is special in the sense that the shipbuilding industry, the finance industry, and the end user are basically, they are more integrated in the sense that, for example, we have seen that for failed deals in the shipyard, where the buyers fail to pay certain installment, it has been taken over by the Chinese leasing companies, and basically they put the vessel to the shipping companies in China or the cargo owners or the power plant or something like that. So there is more a kind of integrated solution within China itself. That is what we see in China, and there are also other pockets of liquidities in Korea, Japan, and Taiwan. So I think no need to say if the credit quality is good, money is definitely available, and it can be very competitive. You can see that few deals that have been done by the oil majors are basically owned by the Chinese or the Korean, and it is cheap. So we are talking about 90, 100% financing, 12 years money at 4.5% interest rate, 5%. But you have to be in that first tier name. And then if you drop to the second tier name, and then you have to know basically to allocate, to find which leasing company are still open for business. And there are still window of opportunities for the second tier or smallest shipping companies, but you have to know who you speak to. Because, for example, now if you go to top 3 or top 4 of the Chinese leasing company, their ticket size is probably close to 100 million. If you come to 20, 30 million deal, they won't just entertain you. And that is a bit of pocket of liquidity in the Asian market.
Okay.
That's all for myself.
Thank you, Ali. Very good points, I think. Firstly, the fact that Chinese leasing companies work very closely with the banking sector, ECAs, and shipyards, which definitely give a very strong competitive advantage to Chinese leasing companies, as well as the fact that Chinese leasing companies are still bullish in the shipping market, which we also see by very simple indicators like the fact that they open regional offices and local offices in many countries, including Greece. Okay, thank you. So I would like to ask George Cambanis to give us his view of how technology, and specifically fintech, is changing the shape of shipping finance today. How you see that trend developing over the next, let's keep it down to 5 years this time.
Okay, thanks. The banking system globally is broken. And fintech comes to address the inefficiencies of systems to try and fix it. From the back office to payments to transactions. What YieldStreet, what this fintech does is, if you think about it, there's trillions of dollars of people's money sitting in bank accounts, earning nothing. So people are hungry for yield. YieldStreet acts on the one hand like a private equity. We have funds and we use those funds to fund a loan. So we will fund the loan, take the ship, the mortgage of the ship, and once that is done, we take that asset-backed loan and sell it online, retail. So people can buy a piece of that loan, $10,000, $20,000, whatever amount they want, and get the yield that we are able to lend the money out to the owner at. This has grown, as I've said. When we started in May of 2018, there was zero shipping. And the platform had $300 million of assets under management and 50,000 subscribers or investors. Today, the platform is 1.2 billion, 250,000 investors growing at 10,000 a month. And we have shipping loans of 250 million out there. So fintech in general will come to address those inefficiencies in banks. And the real question then becomes, will banks get smart about technology before fintech becomes smart about distribution? And the race is on.
Thank you. Now I would like to ask George Laios and Harry Kosmatos if they have any comments. Basically, George, I would like to ask you specifically on the Greek ship finance market. If you've seen, I would like to ask you your views on specifically the Greek ship finance market and how you've seen any changes that you've seen happening in the market. For example, being more financed by Chinese leasing companies or through other sources of capital.
Yeah.
How you see that, again, changing in the next years?
First of all, I want to make a general comment to link it with the previous panel. And regardless of the uncertainty of shipping that we discussed in the previous panel, I think that when it comes to the finance sector, ship finance sector, I think that the landscape has become clearer now. We know that many of the banks have almost finalized this reorientation, others exiting, others entering, others re-entering. We have leasing established itself as a player, a considerable slice of the pie. We have the alternative financiers, private equity, being there, doing considerable deals. We have the Norwegian Oslo market. So, all in all, we know what the picture is now, and by the looks of it, there is capital available to shipping. As I just said, again, the Greek shipping still benefits from the banks. I know that you're referring to Petrofin's research regarding the latest figures that European banks, which is true, have reduced their presence in ship financing. The Greek banks have started increasing their portfolios. The French banks, mainly BNP. So it is these banks, it is leasing, it's alternative financing. You don't see many surprises regarding the terms offered by these financiers, by these lenders. The main structure remains the same. There's no surprises there. There are variations of the definitions of it. So it's not called retention, it's called reserve account, but the main structure is there. Okay, of course, every finance method has its pros and cons. The point I want to make is that everyone's talking, and we just heard the two tiers in the market. The one tier being the owners that actually price takers. Everyone is going to do business for them. And the remaining ship owners that are struggling to get finance. To my opinion, it's three tiers, not two. The first tier is, as we discussed, the top clients, the names that 15, 20, 25 names that we are all aware of, that benefit from very low pricing, very preferential terms. Okay, this is tier one. But there is my tier 2 is the companies that have from 5 to 6 vessels to 12, 13 vessels, all to have family companies, conservative families, traditional families involved in shipping, who survived through the crisis. And then it's tier 3, which are the very small companies with 1, 2, 3 vessels that are either startups or small companies that have managed to survive through the crisis, being from 5 to 6 vessels down to 2 or 3, but they are survivors. So what I see, in all these tiers, there is competition between the lenders. Okay, everyone can understand about the tier 1 clients, okay? But for this, the middle tier, tier 2, there are banks nowadays, name it the Greek banks, some alternative financiers that really want to do business for this kind of clients, τους νοικοκυρέους που λέμε. So there is competition for this tier as well. Now, the third tier, which it's nothing wrong with them, it's just that they are small companies. Again, there is lenders that are willing to take the risk at a higher pricing, I agree, at not favorable terms, but there is financing for them as well. Now, if you want to discuss about terms, or pricing, I know that you're all aware about the disadvantages and advantages of all the forms, like the pricing, flexibility, term, profile of the loan. We are all aware, but the point I want to make is that there is capital out there for shipping, but in my mind is a three-tier.
Mm-hmm. Yes, I definitely agree with your three-tier division. What I've seen, at least, from an shipping finance advisor's perspective, is that although tier 3 clients traditionally had access to shipping banks, essentially, so they could get low-priced loans, those essentially now legacy loans are not there for them anymore. And this indeed creates a problem because although there is capital availability, in most cases it's extremely expensive, making it in many cases impossible for those companies to survive. So I don't know if that's a good link for you, Harry, from TEN's perspective. If you could give us, we're going to talk about opportunities and threats that this new ship finance landscape has created on our second part, which is basically right after any comments that you may have on the ship finance market and how TEN has, if you have experienced any changes.
Okay, thank you for that. No, I totally agree with George. We have all these tiers that we need to deal with, or the banking sector, the finance community would need to deal with. The issue here is not so much on the availability of financing, because finance will always be available in one form or another, even for the tier 3 or 4 owners. The issue is that we need to have the banks to be a little more selective in who they bank with. Shipping finance, the plain vanilla ship finance, was, is, and will remain the cornerstone, the backbone of ship finance. You will not venture unless you are, I would say, a quality startup to raise alternative means of financing from the get-go. You need to go out to your bank and get your plain vanilla financing to get started. Mm-hmm. Then, for you to explore the other alternatives, you have to have a growth plan. You need to identify, you need to set up goals and identify how each step of your growth will be financed. Starting with what there are occasionally more expensive means of financing from the get-go could be very destructive for your company long term, unless you have you're a really kind of quality and well thought plan. The issue is that we need to stop the banks to give free money to everyone, and that was the issue that we faced a few years back when the markets collapsed back in 2009, 10, 11, because of oversupply. We had banks financing every Tom, Dick, and Harry ordering vessels. So we need that to stop. And one positive thing that we have seen over the last few years with the crisis and the elimination of a number of banks from the finance fabric is that this free money has somewhat stopped, and that, in a way, does not incentivize that overbuilding. In a way, we didn't see that with the new money, the private equity money, that irrespective to the banks that were primarily financing, the traditional banks were primarily financing the owner. It was a name lending exercise. We had all these small private equities going after a project and going after returns. And on many occasions, going after unreal returns. They were expecting to see 20, 30, 40% growth, IRRs, which, okay, if there is an industry that can produce that, that is shipping, but it's not very often that you see this kind of mega returns. So once they realized that this kind of returns were not there, they started, jumping off the windows, and that created this void of finance, and had a number of the small companies and on occasions big companies going under, because effectively they didn't have any means, any other alternative means to finance that. From our perspective, being a public company, a US public company, we like to think we are in the top tier, the tier one that George mentioned. We do have plenty, we have a plethora of products to explore. As I said, shipping finance will remain the backbone, but being a kind of a company that has gone through the cycles, has negotiated all the downturns and come out successfully, that has enabled us to have access to all sorts of alternative products, from the plain vanilla, call it follow-on offerings, equity, to preferreds, to sell and leasebacks, to Chinese leasing, Japanese leasing, and everything in between we have looked at. So in a way that gives you, the luxury to choose and create a bespoke product for what you're thinking of doing. As I'm saying, all these alternative means, they are a medicine that should be taken in certain doses. You should not just down the bottle. You should have a really well thought out plan before you venture into the unknown of alternative finance.
Okay, thank you, Harry, for the very informative and interesting comment. I think that we've now established the fact that although ship finance markets are still shifting, this initial huge change that we experienced over the last, let's say, 8 to 5 years is more or less kind of settling now, so we can see things a bit clearer. So I would like to jump onto part 2 of our discussion, which mainly is going to focus on the opportunities and threats that this new environment has created for ship owners. But mainly I would like to focus on the average size, let's say, of a Greek ship owner, which captures the largest percentage of the market in terms of at least numbers of companies, which I think would stand somewhere in between tier 1 and tier 2, the way George Laios explained it. So with that in mind, I would like to ask Harry, I agree with the fact that free money has been reduced, and that may create some healthy competition, some kind of creative distraction. But doesn't that mean that tier 1 borrowers will still have availability to free capital, even though they might not be the most efficient, thus meaning that this might be survival of the biggest rather than survival of the fittest? So, I mean, we've seen that, with the influx of fresh capital, and especially the continuation of very cheap capital to big corporations, the number of M&A activity has, of course, increased. And that's probably primarily, let's say, because of the fact that capital availability to smaller owners is still there, but much more expensive. So, yeah, basically, I just wanted to ask what's your thoughts on that, on this kind of shift because of cheap capital to tier 1 owners, not so much availability. How do you think this will affect the shipping market, essentially?
Well, tier 1 owners always had and always will have access to capital. In the end of the day, it all depends on the project and the vessel in question. We are beginning to see banks taking a step backwards and perhaps moving away or somewhat away from direct name lending, and also paying a little more attention on the vessel and the cash generating ability that the vessel will have under the particular financing. But it's important, as I said in my earlier comment, for those banks not to start financing irrespective of the project just because they like the name. The project needs to work. A project could easily fail under a tier 1 owner as well as under a tier 3 or tier 4, tier 4 owner. So the project needs to work no matter what the name of the owner is. And that's what we need the banks focusing on. This is very important. And unfortunately, we didn't see this qualitative approach so much from the private equity funds, because as I mentioned earlier, they were chasing the returns rather than focusing and doing the proper due diligence on the owner and the background and the business plan in question. So yes, we are seeing a shift in ship finance, absolutely, but I think for the better, unless I don't know, we go back in a VLCC environment of $200,000 per day for like 3-4 years, and then people go kind of crazy again and begin to forget all those qualitative principles that they need to adhere by. Finance will always be available for the tier 2 and tier 3 owners, but obviously at more expensive terms. But the lower you go, and when we say tier 3 owners, it's not necessarily qualitative, because you still have very good companies, small companies. So it's the size of the size of the fleet in question. And unfortunately, there are some very good names that, for whatever reason, they shrunk from being big owners into kind of small size owners. So these kind of names will continue to have access to capital. They will get penalized, unfortunately, because of the size of the fleet, because under certain bank mandates, they need to lend to owners with a certain volume of vessels in order to spread over the risk, but they will have access to capital. Now, the tier 3 owners that are startups, new guys wanting to, they raised money from friends and family, and they want to go into the next level. Then at that stage, I'm afraid bank financing will not be available, so they would inevitably need to seek alternative means, more expensive needs. So they are adding up a number of various layers of risks in their business model.
Okay.
So they are in a way taking a bigger risk, but that's the only way for them to finance the existence and the growth of that new entity. So even though that kind of call it angel capital was more in abundance a few years ago, it's still available under very certain circumstances today, but not so freely available. But if you look and you have the right project, perhaps that startup could be able to get going by getting an expensive financing, but financing nonetheless.
Okay, thank you. Now, basically opening the floor for a discussion between all of us, I would like to direct essentially the same question. Which opportunities do you see with the new ship finance reality, let's say, for ship owners? And I would like us to focus on the opportunities, since it's the name of our panel as well, and in the interest of time as well. And I would like to start with George Laios, as an expert in the Greek market. This is probably most interesting to our viewers.
Despite the fact that I'm notoriously known as an over-optimist, as a character, I would like to start with a thread.
Threads, okay.
Because I want to make a comment on what Harris just said.
Yep.
We said that there is capital there, but linking again with the previous panel regarding ESG, Poseidon principles, the new Green Deal of EU, I don't have the answer to that, but it's food for thought for everyone. What would happen? What will happen in 3 years' time when someone, even a tier 1 client, wants to buy or refinance a balloon of a vessel which is 12, 13, 14 years old? which is a modern vessel. It's not an old vessel. But his tier 1 banks will not be able to finance it because they have assigned the principal rules which don't allow them to finance old vessels. Keep in mind that we talked about the leasing, and the leasing, again, prefers new buildings or modern vessels. Mm-hmm. So taking out of the equation 16 banks, if I'm not mistaken, of the Poseidon principles, which is 140 billion portfolio, taking out leasing, then these vessels have to be financed from private equities or alternative financing. And this is something, again, I don't have the answer, but what will happen to this vessel? Because we recently helped one of our tier 1 clients that his tier 1 bank didn't refinance his balloon of a crude tanker that was 14 years old. And a very good client of the bank, nothing bad with it, said, okay, we cannot refinance your balloon. But why? Because the vessel is 14 years old. Yes, we recently signed the Poseidon principles. So we assisted him to find financing. Again, tier 1 bank. So again, I don't have the answer, but if there is a threat to my eyes, this is what will happen in 2-3 years' time where...
No, if you are a tier 1 client, ship owner, and when I mean tier 1, I mean with all the sense of the word, not just having a big fleet, but not having rust buckets, having a decent kind of fleet, then yes, the bank has every right to object in refinancing an older vessel at that point in the cycle. But being a tier 1 client that will enable you to seek alternative sources or alternative means. One could be, I don't know, a Chinese leasing or a plain vanilla sale and leaseback kind of opportunity. More expensive, but at least it will provide the funds to take out that balloon out. So it gives you, by being a tier 1 client, you have this plethora of options that you could explore, which you don't have as you kind of go down, the tier list. So it's kind of, it's a juggling act.
If I may add a comment, since so far we've been commenting on ESG as a factor that essentially will reduce ship financing even further, especially from traditional banks, couldn't ESG principles be seen as an opportunity to invest into cleaner, new building vessels? And I'm saying that because, in my understanding, through the Poseidon principles, shipping financing banks will be judged on a portfolio.
But this is dangerous, Konstantin. This is dangerous because you're incentivizing people to go into the new building front, which you don't want to.
Yes, I understand.
Because you will be shooting yourself in the foot.
But I don't mean that the reduction in capital should be fully replaced by fresh capital for new buildings. I mean that it can gradually reduce each of the bank's emission footprint, essentially, the ones by which there will be essentially judged on the portfolio basis. So they can continue essentially financing, let's say, older assets that are more harmful to the environment and basically counteract to those increased emissions by financing new building vessels that are greener.
Well, older assets of quality owners need to be financed one way or another.
Yes.
And it's a bank's obligation to finance them, in my book. Okay. It would be wrong to finance, older assets of substandard owners. The last thing you want is to stop financing or refinancing older assets, which could potentially lead to the owner seeking alternative means to cut costs, and that could be, cutting operating expenses, maintenance, and things like that. Yes. That could put the actual safety of the vessel and the quality of the vessel in jeopardy. So the last thing you want is to start kind of pushing the owner towards cost cutting just to save the money because financing was not available because of these Poseidon principles that are kind of fashionable, and we need to be kind of Greta friendly here.
Okay, understood. Yes, whoever wants to.
Perhaps I may add on that. I mean, what I see is simply the fact that banks have stricter, not only external regulations, but internal policies. And I mean, you mentioned the example of a vessel which has a reasonable age, so it has a reasonable remaining lifetime. So from that point of view, should be no problem. Nevertheless, for banks these days, at least, it is definitely more difficult. And that is exactly the area where I would see the opportunity for the alternative financing or credit funds or private equity, whatever you want to call it. If you are able to make up your mind on the vessel, so that is even a step further, not only, I mean, we talked about maybe 3 tiers, but that was more related to my understanding to the ranking of names or quality of names. Then we discussed the question, what about the project? And banks also nowadays might more look into the project and not only assessing the balance sheet of a certain name. But I would go a step further and say there's an opportunity for credit funds if you go even a bit deeper in the single asset. But that means you have to organize the capability to assess the vessel. I mean, you can't perhaps not do it on your own, but then you need access to experts who are helping you. And if you then find a way how you can focus on, as you call it, liquid assets, I think then you can open up a quite interesting scope of opportunities where you can offer financing for the existing tonnage, which might be 10, 12, 13 years old. There's a reasonable remaining lifetime, and you can do that. But as a matter of fact, I think this is indeed, as you already mentioned, less the area for the banks. Those banks who remain active will, to my mind, more look into new building projects, bigger projects. But if you want to build up a portfolio which is based on existing vessels, maybe smaller amounts, then this is the area where credit funds can really further grow. That's my impression.
Yeah, absolutely. Thank you, Christoph. George, you wanted to add something?
Yeah, the older vessels, there's a lot of life and use for older vessels. And the small and medium-sized ship owners prefer the older vessels. We love older vessels because we can fund them and be scrap covered. And the owner can use them in situations and make money out of it. So the owner, first of all, has to make money for us to make money. So we look at the project very carefully and fund the older vessels. The second opportunity I see is the banks have sold their portfolios to hedge funds and private equities, and the owners have an opportunity to go and buy those vessels, their own vessels, back from those funds. So the fund pays 40 cents in the dollar, the loan is 70 million, the assets are worth 50 million, so they paid 30 million for a $50 million asset. There's room for everybody. The hedge fund can make money, the owner can make money, and we can fund that acquisition. So it's not only the first-tier owners that go and buy brand new ships and get Chinese leases to fund them that are in the market. The market is made up of more little and medium-sized owners than there are first-tier owners. And we provide the situational funding to help those owners also make money.
Understood. So that's one opportunity.
If I may, on George's point, there are horses for courses. So yes, you could have all these private equities and credit funds stepping in, but bear in mind that by default, this kind of financiers do not have the same, perhaps risk appetite profile with you. They are by default short-term investors. Being an owner, naturally, you're kind of long-term investor. So you need to make sure that you go to bed with the absolute right partner, that at least for the short term, your goals in a way align.
Essentially, it's a double-edged sword. More capital availability, but probably
yes,
more
very
expensive.
dangerous. You need to it's very, you just don't pick the first source, out of the box. You need to make sure that this person giving you the money, the more expensive money, because in a way, the bank is across you on the deal, on the table. By bringing a credit fund, a private equity fund, you're bringing them on your side. Okay. So you need to make sure that they will not have different risk appetite and strategic kind of outlook much different than yours, because eventually they will force you to do things that you wouldn't have done anyway, and then things could go nasty very quickly.
Okay, thank you, Harry. So to quickly conclude, because we're running out of time, would you?
Maybe I want to add a bit. I agree actually on the older vessel also. We are in fact just having a bit of second tier shipping company raise financing for 14 and 16 years old vessels. One is, I agree, from the credit fund. The other one, surprisingly, we got also from the Japanese investors. So we arranged basically a Japanese operating lease with call option with vessel of that age. This is more a bit of new product or structure from the Japanese market, because traditionally they are looking more into new vessels, bigger deals, but they are now also pockets of liquidity where they are looking also into older vessels, but their point of view is very similar to the credit, because they see their exposure is basically for 1.5, 2 years where there will be scrap cover, so they see their risk is quite manageable. But what I want to say now to add other potential threat is also for the shipping companies to think a bit about the future and strategy of the shipping companies, because I mentioned before that these Chinese shipping companies can now also basically become a ship owner. So the line between financier and ship owners become more blurry. So we have seen few of the shipping company, basically, if you ask them what is their target, basically their target is end user, cargo owners, and they do not shy away from signing new building contract with the Chinese shipyard, of course, and then take delivery and time charter the vessel to the cargo owners or the end user.
Thank you, Ali. Excuse me, sorry for interrupting. Just one last comment from Dimitris, because we have to sum up, we're run out of time essentially.
Make a small correction to George's statement. You'll be amazed how many ships have no mortgages, meaning that they get no loans. I calculate that it's about 25% of the Greek fleet is mortgage-free, maybe more. That's the minimum, 25. Then another thing that I want to make a remark is that, and that's the last part of a question that I didn't answer about the future. Lately, we see a softening in pricing from banks, also a softening of pricing from funds. Usually all funds that were giving double-digit margins, they are now below their single-digit margin. So we see the circle, the cyclical part of shipping repeat itself, and history repeats itself. So if there is a crisis in front of us, either due to a deglobalization, that my friend Martin Stofford could say something. So if there is a deglobalization with the protectionism and the political leaders that they run the world this period, plus the viruses, plus all these things, we will see again the circle repeating itself.
Thank you, Dimitris. Sorry, we've run out of time. Just to quickly conclude, if I may say so, hopefully I'm correct. So understand that this shifting environment in ship finance, which is now clear, as George very rightly said, is creating more opportunities, but also more threats by allowing a wider availability to capital, from senior loans to pure private equity to common equity, which of course comes with a higher pricing, especially for newcomers to shipping. So at this point, I would like to thank you all for being here with us and closely following what we said. And I would like to thank Despina Travlou for having us, and our panelists, of course, for sharing their views with us. Thank you. Please give a warm applause to our panelists. Thank you.